Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In Part 2, we'll explore strategies for investing in small-cap stocks and how they perform in various market cycles. Imagine running a lemonade stand competing against Coca-Cola. That's the reality for many small-cap companies. Their challenges include thin cash buffers. Missing one earnings target can trigger layoffs or halted projects. Competition. Big firms can undercut prices or outspend them on marketing. Scaling struggles. Going national or upgrading technology strains limited budgets. Some small caps overcome these hurdles brilliantly. Others flame out. Unlike Apple or Walmart, they rarely have decades of stable profits to fall back on. Lower liquidity. Try selling a rare comic book versus a best-selling novel. The novel sells instantly. The comic book might take weeks unless you slash the price. Small-cap stocks face the same issue. Bid-ask spreads widen during downturns, costing you more to exit positions. Large institutional investors often avoid small caps because they can't move big money in and out smoothly. This lack of liquidity amplifies losses in a crisis. While IWM mitigates this somewhat, its highly liquid, individual small-cap stocks can become untradeable when markets freeze up. The takeaway? Small caps demand patience and a stomach for bumps. They can turbocharge returns, but you'll endure more white-knuckle moments along the way. How to invest in small-cap stocks. Investing in small-cap stocks requires a mix of patience, research, and risk management. Unlike large caps, these stocks don't come with the safety net of Wall Street acclaim or steady cash flows. But for those willing to dig deeper, the rewards can be substantial. Whether you prefer cherry-picking individual stocks or taking a diversified approach through funds, here's how to tackle this high-potential segment. Direct stock picking. Finding hidden gems. Picking small-cap stocks is like scouting for minor league players before they hit the majors. The upside is huge, but so is the risk of striking out. Focus on these key areas to improve your odds. Financial health. Look for companies with strong balance sheets, low debt, solid cash flow, rather than flashy revenue growth alone. Small caps with shaky finances can collapse under pressure. Management quality. Research the leadership team. Have they successfully scaled businesses before? Are their incentives aligned with shareholders, e.g., skin in the game via stock ownership? Industry trends. Target sectors with tailwinds. A biotech firm developing breakthrough drugs or a software company automating niche industries has better odds than a Me-Too retailer. Pro tip. Ignore penny stocks trading under $5. Many lack fundamentals and are prone to manipulation. Stick to legitimate small caps with clear growth paths. ETFs and index funds, like IWM, the stress-free approach. Not everyone has time to analyze hundreds of small cap stocks. That's where ETFs like the iShares Russell 2000 ETF, IWM, shine. They offer instant diversification across the sector with a single trade. Here's why this works. Built-in variety. IWM holds approximately 2,000 stocks, spreading risk across industries. One company's failure won't tank your portfolio. Lower costs. With an expense ratio of 0.19%, it's cheaper than most mutual funds. Over time, fees eat into returns, so keep them minimal. Liquidity. IWM trades millions of shares daily, so you can enter or exit positions easily, even during volatile markets. Index investing won't give you 10x returns, but it smooths out the bumps while still capturing small cap growth. Mutual funds and active management, when experts step in. Actively managed small-cap mutual funds aim to beat benchmarks like the Russell 2000. Skilled managers use deep research to uncover mispriced stocks before the crowd notices. Here's what to consider. Performance consistency. Check long-term track records, 5+ years. Many funds outperform briefly, then falter. Fees matter. High expense ratios, greater than 1%, can erase gains. Compare funds like Fidelity Small Cap Growth, FCPGX, 0.83% fee, against cheaper index options. Turnover rates. Frequent trading drives up taxes and costs. Look for funds with lower turnover, under 50%. Active management shines in inefficient markets, like small caps, but it's not a guarantee. Always weigh fees against potential upside. Small cap stocks in different market conditions. Small cap stocks don't perform the same in every market. Their size and focus make them react differently to economic shifts. Understanding these patterns helps you spot opportunities or avoid traps when conditions change. Performance during economic expansions. Small caps shine when the economy grows. Their domestic focus and lean operations let them capitalize on rising consumer spending and business investment. Unlike large multinationals, they aren't weighed down by overseas risks or bloated corporate structures. Here's why they thrive. Local advantage. Most small-cap revenue comes from the U.S., so they benefit directly from tax cuts, infrastructure spending, or wage growth. Faster adaptation. They pivot quickly. A small tech firm can shift product lines faster than a tech giant bogged down by bureaucracy. Earnings leverage. Even modest sales growth can turbocharge profits since their cost bases stay low. Historically, the Russell 2000, tracked by IWM, outperforms the S&P 500 early in recovery cycles. Think of small caps as speedboats, they zip ahead while large caps turn like cruise ships. Behavior during recessions. Small caps often struggle when the economy contracts. Their lack of scale leaves them exposed to credit crunches, falling demand, and investor panic. During the 2008 crisis, the Russell 2000 dropped 34%, while the S&P 500 fell 38%, but small caps took longer to recover. Key weaknesses in downturns. Credit dependence. Banks tighten lending, and small firms rely more on loans than blue chips with huge cash reserves. Cyclical tilt. Many small caps operate in sectors like retail or construction, which slump when consumers pull back. Liquidity drains. As investors flee to safety, small cap trading volumes dry up, worsening price drops. Recessions test small cap survival skills. The strongest companies emerge leaner, but many don't make it. If you invest in small caps during rough patches, focus on those with clean balance sheets and essential products. Market cycles shape small cap returns more dramatically than large caps. Pay attention to the economic backdrop. It's the difference between catching a wave or wiping out. Small cap stocks, like those in the IWM ETF, offer a mix of high growth potential and higher risk. They can outperform large caps over time, but their volatility and sensitivity to economic shifts demand patience. Diversifying through funds like IWM helps spread risk, while direct stock picking requires deeper research. Before jumping in, ask yourself, does my risk tolerance match the swings of small caps? Are my goals long-term enough to ride out downturns? If you're unsure, start with a small position or talk to a financial advisor. For those ready to explore, IWM provides a straightforward way to tap into this dynamic part of the market. Want to dive deeper? Check out our guide on balancing small caps in a diversified portfolio. This video helps you navigate your strategy with clarity. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.